get to interview amazing founders, investors, vendors to help founders build great companies and learn from success and advice from those who've made it. And today I have a special guest that I'm so excited to welcome to the show, Eric Pali. They claim to be the most founder-aligned investor, and the claim is true. I've been blessed to benefit from Eric's advice and wisdom through the years of building ClassTag, and I am thrilled to share Eric's advice and welcome Eric to the show. Hi, Eric.
Hi, thanks for having me.
Well, before we dive into the questions, which I have plenty, and it's so thrilling to be on the sort of other side, not as a founder per se, and actually get more in your head and ask some tough questions maybe that I couldn't ask before. But I I would want to ask you for a brief introduction before we dive in.
Sure. Well, I was an entrepreneur. I founded two companies. One right before I went to business school that still exists today that my brother runs called Abstract Edge. And then I founded another company after business school with Micah Rosenblum called Brontes Technologies, which our first investor was David Frankel. And I mentioned the two of them because those are two of my three partners today at the venture fund we founded in 2009 called Founder Collective. And like you said, we founded the fund with the mission to be the most aligned fund for founders at the seed stage. We're less interested in that as sort of a marketing claim and much more interested in that as a ethos and acid test of everything we do. Are we living up to that? So I appreciate you saying that you were on the receiving side of that with ClassTag. We work really hard to live up to that mission.
Thank you, Eric. And you guys hire only those who've built companies in the past. Is that right?
Yeah,
Most of
everyone on
them.
the team is a builder. That's really important to us because I think without that, you might be a great investor, but you don't necessarily have a lot of empathy for the process the entrepreneur is going through. And also, I think there's something to be said for when you give the entrepreneur advice and they don't like that advice, which sometimes happens. Do they hear the advice from the standpoint of someone who's been in their shoes, or do they hear it from someone who maybe doesn't know what they're talking about because they've never had to do this before?
Yeah.
It doesn't mean the person doesn't know what they're talking about, but I think it makes it even harder to receive, challenging advice that differs from what the entrepreneur is thinking in that moment when they just don't really know whether the person giving the advice has ever really appreciated what they're going through.
Yeah, and it's so true. I've had certainly a wide range of investors and those that haven't been founders before can come and say, hey, how come you missed your plan by 20%, right? When you're a seed stage company, it's like, because they're used to, looking at maybe, financials of public companies, and they just don't understand sort of what it takes to actually be anywhere close 20% this way or that way, right? And the level of precision that you can have. So absolutely. And I think I felt it as a founder through various interactions with you, and of course with the broader team as well. So my goal today, Eric, is to help founders who, of course, are fundraising. In fact, many founders spend perhaps majority of their time fundraising at different periods in their startup journey. So I wanted to start by asking you, what is the biggest mistake you see founders make when fundraising?
I think the biggest mistake I see founders make is they think fundraising is like getting a grade in school or some binary notion of success or failure. You have a group of people who are by nature overachievers and they want to overachieve in some sense of fundraising. So that may sound funny because for most folks, even just getting capital is hard. But once you're getting capital, people get very focused on the terms. And that's fine. I would never tell a founder that they shouldn't care about their dilution or the economics of the deal. But the real challenge is you are going into business with these people and you kind of can't ever get out of it. They can fire you usually, but you really can't fire them. And so I heard one VC have a great line about this, which is, when you marry for money, you rarely get happiness. I think when you take a investment round from someone based on the best economics, you rarely get a great partnership. Doesn't mean you don't get both sometimes, but usually you rationalize that you're getting both. You're like, well, I like this person the most because they gave me the best deal.
Right.
And I think the truth is you really have to look for, who do you want to be in business with? Would you give a co-founder who's fantastic an extra 1% of the company because, your partnership with them is going to be incredible? Or would you rather have someone at a discount who's going to be difficult to work with? And
Right.
even a co-founder usually can fire, a board member you can't. So board members can really destroy companies and destroy value, or at least create enormous extra pain. And the question is, who are you getting into business with? And I think that's the number one mistake people make, who have choice. Most people, when they're able to get capital, have choice, which is a funny idea, because up until the point where you're getting that money or you have a first offer, usually can't imagine having choice because it's so hard to get any capital up until
Right.
that point. So we can talk about getting through that stage as well. But once you have choice, you have to think really hard about who you want to be in business with.
Thank you, Eric. And it's really interesting that you're getting to that stage when you become attractive, and then you have sort of multiple offers. But so let's maybe talk about what makes business attractive, right? When a pitch comes to you, right? What do you look at first? How does it come to you? Do you respond to cold outreach? Is it only introductions? What kind of introductions? Let's kind of pull the curtain and talk about kind of practical aspects of how you invest.
Sure. Well, very practically, we try to review absolutely every single thing that comes into us. If you send us something cold, it is not as good as if you can find somebody we trust who sends us something, because the quality of the entrepreneur or the individual is an important thing for us. And if we're getting your information cold, the only thing we're getting is sort of your resume. But if somebody knows you, Vlada, and you recommend them to me, that's really means a lot to me, because I trust you, I know you, I value your opinion. And so I'm not just getting your resume, the entrepreneur's resume, but I'm getting the endorsement of somebody I think highly of. So if there's a way in that's not cold, by the way, there are a lot of funds who won't even look at their cold inbound.
Right.
So if there's a way in that's not cold, if you can get on LinkedIn and figure out who might know this entrepreneur that this fund that you might know, that's great. And there's a hierarchy to that too, to be honest, right? Which
Mm-hmm.
is,
Of
an
course.
entrepreneur who's been successful in the VC's portfolio is usually the most impactful, followed by an entrepreneur maybe who hasn't been as successful, but at least they know well. Probably followed by notable senior people in the community. Um, and then I'd say below that is somebody who's already an investor. And the reason that's the someone who's already an investor is less exciting, unless they're investing concurrently,
Right.
is, they need to help find more money for the company.
Right.
So that doesn't mean it's not a great company, but the signal on the endorsement is a little less exciting.
Right.
And then the last in that is service providers, or folks that the VC might only know at a distance, or perhaps not have such a high opinion of. And again, that doesn't mean it's a bad company just because somebody comes in that introduced by somebody that I don't know very well, but it's just harder for me to really get any kind of signal on the person's talent and character from that. And then, of course, the way somebody introduces you matters. And so you want to make sure it's somebody who thinks very highly of you, because this is like getting back to the getting A's in college or being an overachiever. This is a little bit like your letter of recommendation, right? If somebody says, oh, yeah, I've known Vlada for a long time, she's a solid citizen, that's not nearly as exciting as Vlad is one of the smartest people I've ever worked with. I'm writing a check into her,
Mm-hmm.
or I'm just so
Right.
excited about what she's building. Those endorsements are different, and I'd even take a a lower on the hierarchy type of endorsement with a better quality of endorsement
Right.
in language. So there is a lot to this in terms of making it strong. We don't respond to every cold inbound we get with feedback, because we know we're only getting a surface view. We do ask everyone who comes in cold to send us a deck. And so much. So by the way, everyone who comes in warm, we ask for a deck too. And if you offer to make an intro to us, Vlada, and you don't send us a deck, we'll say, hey, Vlada, this looks great. Um, Assuming we think it's something that could be interesting, but can you either help us get a deck or just introduce us to the founder and we'll ask them. And the reason we do that is twofold. One is we never want to waste an entrepreneur's time. So we want to make sure that this is something we'd really consider. And that's hard to do just from a paragraph.
Right.
The other thing we're doing, this is really important, is making sure there's no conflict in our portfolio. We don't want to engage the entrepreneur and have them feel, we never share their information. We don't want to engage them and then have them in the middle of a meeting say, wait, what? You're an investor in our competitor? Are you just trying to get intelligence from me?
Right.
We don't want anyone to feel ever in that position. And so we're always, and again, from a paragraph, it is sometimes hard to tell. But from a full deck, usually we can tell. And then we never share anyone's materials outside of the fund without permission, at least. So that's like a little bit of the tactical side
Mhm.
so the deck ends up being really important. And some people don't want it to be, or they'd like the intro alone to get them the meeting. But I don't really think you want to go pitching people who don't really know, they're not prepared at all for the meeting. You want people to be taking the meeting because this is something they're interested in, rather than taking the meeting because, just Vlada asked them to do them a favor
Right.
or do you a favor, right? That, if you're making the introduction, you want it to be more than a favor. You want the person who's receiving the info to be genuinely intrigued.
Absolutely, absolutely. And then when it comes to the actual pitches, right? There are probably thousands or tens of thousands, maybe even pitches that you've heard by now. Sort of what is a good engagement interaction looks like, right? I think what I'm observing it from my standpoint, it feels that a lot of folks are over rotating, thinking they're pitching robots, and so they come in with that sort of robotic pitch as opposed to building relationships, or is it not? Sort of which comes first from your perspective?
So there's a balance, and this is really tricky too. You'll have a lot of people come in and they don't want to take you through a deck, or they're resistant to it because they're just there to build a relationship and get to know you. And I have seen over the years that those people put themselves at a radical disadvantage, right? Whereas it's actually fun for the VC. You'll see a lot of VCs who say, no, don't open a deck, just talk to me. And it's actually more fun than being walked through something. Just like it's more fun to like have a conversation with a
Right.
teacher than actually have them teach you something. But the challenge is it's very easy when you have that kind of meeting to then turn the entrepreneur down and give them an explanation as to why, and they say, oh wait, we never really talked about that in the meeting, but I have a really good answer to that. But you can never get back to the table as an entrepreneur. And
Right.
so there's a little bit of, when we just have the conversation, we're peeling little parts and I can't see the whole thing. I can't see it's an elephant. You just see lots of gray parts as we pull away little, post-it notes from uncovering the elephant, or whatever you want to call that. But if you get to tell your story and you've prepared it well, even if it requires a little more patience on my part and it's a little less, engaged back and forth, it gives the entrepreneur the opportunity to really teach the VC what they're trying to accomplish. And of course, the VC will still ask questions and there will still be give and take. But what you really want as the entrepreneur is that opportunity to tell your prepared story. And of course, a picture is worth 1,000 words, right? And in a PowerPoint, you get to give, or whatever slides, you get to give many pictures. And so the last thing I would recommend is just trying to give a narrative. And the analogy I give for that, a narrative, just talking about it without actually walking people through it. The analogy I give for that is, imagine if every television commercial was just somebody standing up and telling you about their product without showing you, right? It would be very not engaging,
Right.
or maybe I don't know. It would not work, right? And I think your presentation is an opportunity to make it much better than just standing there and telling. It gives you an opportunity to show. So I think it's extremely important. Having said that, yes, you still need to build rapport. And then the thing we're looking most for. So people think we're trying to be idea analysts, right? We're trying to understand whether your idea is going to change the future. We predict the future as VCs. There are VCs who believe that that's what they do. I don't believe that's what I do for a living. What I believe is I meet incredibly talented people and they explain to me why it is they're committing their careers for a meaningful period of time, call it 3 to 15 years, to this thing. And usually I will be at best a somewhat prepared mind, but certainly not a fortune teller of the future about the thing that they're talking about. And what meaning I've looked at a deck, I know I want the meeting, I know I want to engage the entrepreneur and learn more, but their job is to help me understand why are they committing the next 3 to 15 years of their life to this, both from a personal passion standpoint, but even more so from the standpoint of they've engaged the hard questions and they love talking about them. And so what I would say is, unfortunately, 95% of the time, entrepreneurs are defensive about the hard questions. Somebody told them along the way that the answer to like the interview question of what is your weakness is I work too hard. Right? Meaning like the glib, clever, non-real answer to the
Right.
answer. And the challenge with that for evaluating a startup is there are, of course, all these unknowns. And the best entrepreneurs are the ones who engage the unknowns and are really work through them and are trying to find the best answers. And if you're being glib about the unknowns, my assumption is you'll always be glib about the unknowns. And
Mhm.
therefore, you're probably not going to solve them. You might, but you probably won't. You're not showing me your ability to work through those challenges or even your desire to engage them. And so we're really interested in talking to the founders who are willing to be somewhat vulnerable. The language we use for the very best entrepreneurs is they're all over it. All they want to talk about is what's hard and how they're going to solve it, rather than how brilliant their idea is and how none of the hard stuff matters because what they're doing is so clever.
That's excellent perspective, and I I often thought that sort of being a founder requires you to be very confident, but also very sort of open minded at the same time, right? In the same meeting, feel like you don't know anything and you know everything, instead of going in between. And so it sounds like it's along the same lines of
So I have an analogy for that, and I also use it for the people we train in Founder Collective, which is for all of us, there's the compass and there's the dialogue, right? The compass is what do you believe in your soul about what's happening? And if you don't have a compass, you're just impressionable, right? And you can't just be impressionable and be a great entrepreneur or a great investor.
right,
The dialogue is what we engage in the world and learn. But again, you can't, you want to be open to the dialogue and you want to learn from the dialogue, but you don't want to be so impressionable that you have no compass, because again, you can't really do anything different and innovative if you're just listening to everyone's different view, because people are going to
right,
tell you contradictory things. Oh, that's never going to work. Well, if they tell you it's never going to work, you'll be like, all right, I'm done. It's not going to work. And so you kind of need to be moving back and forth. You got to be pulling things from the dialogue so you're learning and it's somewhat influencing your compass, but it's not influencing your compass so much that what you deeply believe in your soul is so fungible, right? And yet you're this heat sinking missile towards learning. And if you're very honest about your compass, you're like, okay, what do I not feel as secure about that I'd like to? Not false security, but real security. And then you're seeking out the answers to those things nonstop, right? And so, if it was class tag, you're saying, I'm not sure the advertising model is the right way to go about this,
right,
maybe, right? And so every day you're like, okay, what are other business models that can work? What is it about the advertising model that's making me slightly uncomfortable? Is it working? To what extent, right? And you're like having the dialogue every day to try to get deeper in your compass about what you believe. But just because somebody tells you, oh, that's a terrible business model, you're not going to be like, okay, that's right, it's a terrible business model, right? Or if somebody says that's absolute genius, like you're not just looking for confirmation bias, right? You're trying to find truth, and that's what your compass is ultimately looking for, and it needs to be open but also rooted, and
yeah.
that's a balance.
Yeah, absolutely. And I think one of the things I've observed, Eric, is that most funds are followers, really, even though they might claim they lead, but they really follow. And I've experienced that when we got to partner with you guys, as to all of a sudden, right, the flood of others opened up that wanted to follow. So, how do you lead, right? Meaning, sort of we talk about sort of more qualitative aspects. what really excites you about a space idea founder to lean in?
Yeah, I think in a world of great ambiguity, and all venture-backed startups are incredibly ambiguous, it is a lot easier to move forward when you're getting signals, right? So we talked about signals around the quality of the intro, or we might do reference calls on a founder, and we're looking for signals. And the easiest signal in our industry is some other venture capitalist liking a company. I
Mhm.
actually joke, but there's some truth in this. The definition of a good deal in venture capital is a company that other VCs you respect want to invest in. So if you spend a lot of time looking at something and nobody else seems interested, it probably isn't a good deal. And if you spend a lot of time looking at something and all of a sudden lots of people are interested, or someone really smart does it, you're like, oh man, I missed a good deal. But at the end of the day, what we're then doing is we're being overly influenced by the dialogue, right? That we talked about before. And this is one of the most important things in training our people as we add people to our team, is helping them understand it isn't a good company. We try not to say deal. I use deal in that sense to sort of joke about the industry, but um, we don't think something's a good company because smart people like it. We have to independently come to that, right? And ideally, we're independently coming to that ahead of other people. And if we do that, if we're sort of non-consensus and right, to use Mike
Mhm.
Maple's favorite phrase, that's an incredible opportunity to succeed, right? I think in our industry, being consensus and somewhat right, usually you don't actually do that well for a whole bunch of reasons, right? Meaning there's massive competition, there are a million
Right, valuations
companies
just through
in
the
that space. And so just sort of like things getting hot because VCs tend to chase each other, because again, in a world of ambiguity, that's the signal they tend to respond to. um, I don't think that's a good thesis for investing, and we have to remind ourselves of that. In very early days, there was a company I spent some time on, and then two of the investors I most admired ended up leading the round. And I sent a note to my partner saying, I'm sorry I screwed this up because I saw it before them and I should have been on this. And one of my partners rightfully said back, let's decide whether you screwed it up when the company exits, not, in whatever 5 to 12 years, not
right.
now. And of course, at the end of the day, the company did not have a successful exit. It did not return money. And that's the truth, is most companies do not, no matter how good the investors are. And so, it's not a good opportunity or a good company just because someone smart likes it. It's actually very important we're all exercising our compass in judging those things. How do we do it? We do it by reminding ourselves of that a lot, and then doing the first principles work on what do we think is a great company and why. What do we think is a great entrepreneur, because that's the number one driver, and why. And I told you, and I remember having the conversation, Vlada, that when we invested, I've been very fortunate to invest in some extraordinary people who have done extraordinary things, and you remind me of those people. Your characteristics remind me of those people. Now, it doesn't mean at the end of the day, everybody who has those
Mhm.
characteristics will be wildly, multi-decacorn successful. But to me, it is a necessary ingredient, and it's not an easy ingredient to find, right? So when you find it, that's a very special opportunity.
Thank you, Eric. And I um, I remember the early conversations, and I remember how deep you actually went into the fundamental questions. Unlike, I think, some other conversations I had early on, when it was sort of more kind of high level review of the business plans and metrics. You didn't. I don't even know if you looked at my business plans. You had your own model, and you said, okay, what are these assumptions, and how does how do you go from A to B? And so it was clear that you were doing your own independent work regardless of whatever models or projections I provided, and that was really unique.
I am definitely less interested in anyone's specific model, although sometimes it's an interesting conversation to see how they think. But what I'm really interested in is how do you think, right? And
Mhm.
so if I'm looking at your business and I've got a lot of questions I'm trying to work through and understand, it's not because I'm trying to, at the end of the day, convince myself of your business. It's because I'm trying to see how you think about it and whether I think you've um, gotten way out ahead of the conversation and dealt with all, really engaged the hard parts. Because to me, those are the entrepreneurs who work it out. Like I will constantly be surprised to see things I doubted work in various ways. And you could say, well, you get to be the investor, so why do you ever invest in anything you doubt? I think a good example is there are many changes in our companies after we invest. And the entrepreneur will explain things to me about what they're going to do. And I'll think, well, I don't know that I would do that. Like that doesn't totally resonate with me. But the entrepreneurs really thought this out. They've gone deep on this, and
Right.
maybe they're right. And then it works. And you're like, well, geez, good thing I didn't just like go like this based on my own intuition, and instead trusted that the person who was willing to attack the hard problems from day one probably worked through the hard problems here and is going to be successful. And again, it doesn't mean they always will be, but it gives you a very, in baseball, if you bat over 300, you go over a career, you go to the Hall of Fame. That means, 2 out of 3 times you get out. That's kind of the game here too, is, not every great entrepreneur succeeds, but if you have a high enough batting average, you really have a great chance at an incredible fund. And the trick is to support every type of entrepreneur, whether or not it's the one that's going to give you the grand slam or somebody who's really struggling to figure out how to get on base, partially because that's our duty, but also partially because it is not unusual that folks who struggle to get on base then make the pivot that turns it into a great business. And we've had 5 companies that have become worth over $1 billion that took 5 years to get to $1 million in revenue.
Wow.
So, these are all companies that didn't look like killers coming out of the gate. One of them became worth over $10 billion. So, if you give up quickly, there's an old adage in venture capital, great lemons ripen early. And I just don't think it's true. I think it's actually an abusive notion of our industry where we are very happy to give up on entrepreneurs who don't look like the great ones. And there's a story, maybe I'm going to have it untrue, but I believe it's true, that, the original, I don't even need to name the investors, but the original board members who did the Google deal, who get credit to this day for doing the deal, both wanted to go off the board or went off the board at a certain point because they didn't think it was going to be a great winner for them. Right. And so I think the point of that being people give up way too early in our industry, and overcapitalization, which we can talk about, is actually one of the primary reasons people give up. But some of it is just I think the abusive mindset of capital and not understanding what actually has to happen on the ground for the entrepreneur to be successful.
Absolutely, absolutely. And I think um, there is a lot of conversation about pivots, right? And among founders, you say, how long should I be, doing this, right, till I see the breakthrough? And certainly, I think one of the most frustrating things for entrepreneurs is that all their eggs are in one basket, right? They only have that one company, and of course, we know the success rates and whatnot, and so that's but that's a crazy journey they decided to go on, right? And sort of
Yep.
being in market and pivoting and whatnot. But have you seen sort of pivots done well, or when people should give up, or sort of any words of wisdom you have from the pivoting standpoint?
Yeah, I've seen it go in both directions. I've seen entrepreneurs who just kept trying to walk through a wall and they could not walk through it, and they just kept going and going and going and going and going and not getting through it. And I think they're torturing themselves in some contexts, but they're convinced, and it doesn't work out. And they can literally waste numerous years of their 5 years of their life
Yeah.
pursuing something that from early days didn't seem to be working, and they just didn't find real evidence it was working. Sometimes they find some fake indicators or misleading indicators, and that can be a challenge, right? I've seen it the other way, where you see entrepreneurs who just constantly are pivoting in every single direction or giving up too quickly, and they don't execute anything. I used to joke in my first company, people would, I'd say, well, maybe we should do X, and someone would say, well, we've tried that before, and I'd say, well, we've tried everything. We've just tried it all badly. Maybe we should do it well. Because it's
Right,
not going to usually work if you don't do it. You can
right.
experiment, but it has to be a good experiment, right? And you can't do too many experiments at once because you're not going to do any of the experiments well. And so some of it's the discipline to have like actually a good, I won't, it's not really scientific method, but actually like, if you do
Give it
poor
a shot.
scientific
Give it a
method,
real shot.
you
Yeah.
get poor science, right?
Yeah.
And so I think the balance, which is very hard as an investor, because the entrepreneur who lives on the ground, but very often, they're doing this for the first time, and they have at times blind confidence in what it is that motivated them to pursue it in the first place.
Right.
Right. And so it's a very, very hard balance. But I think at the end of the day, the entrepreneur understanding that what the passion that drove them to do this is really a problem, usually, if it's done right, is a problem, not a solution.
Mhm.
And no matter how clever their solution feels to them in a moment, they need to constantly be pursuing learning and data against that in the real world. And as they learn, they need to get closer and closer and closer to what actually matters for solving the problem. And if they do that process well with an openness, they don't have to give up on their values. Their compass doesn't need to go away, and there does need to be a bit of persistence and stubbornness, but you need to also have an openness about, okay, why isn't this working exactly the way I want it to work? And what am I learning from this? Like, everything needs to be met in the real world. There's that old, I hate quoting Mike Tyson because I'm not a big fan, but there's his right. He's got that famous quote that like, you can always have a plan until I punch you in the face or
Yeah.
something. Like you have to go do that, right? You have to go get hit in the face because that's the real world. And the sooner you engage the real world with something that you think is a genuine test of what you're trying to do, the sooner you can adapt. And thinking of it as adapting is really key. Like you have to constantly adapt. Like a good hitter going to face a great pitcher, they should have a higher batting average in their third or fourth at bat against that pitcher than in the first or second. You can tell I'm a big
Right.
baseball fan more than Mike Tyson fan, um, because they're adapting. They're seeing and learning about how to adapt to that pitcher. It's easier for a hitter to adapt to a pitcher than a pitcher to adapt to a hitter, right? And you have to constantly be adapting from your learnings. And if you're not doing that, you're probably just going to try to keep running through a wall. And there's a lot of admiration or sort of positive heroism around, oh, that person runs through walls. You can't really run through walls in real life. And so just
Mhm.
running into walls over and over again is not really a very good thing to
Strategy.
do.
Yeah. Absolutely. And yeah, that's a great analogy to help folks visualize what that looks like. And I think wanted to go back for a moment about um, to the metrics, right? And so we talked a lot about the sort of the founder and the mindset and how they pitch, but obviously, we are in the environment now when funding became more scarce, right? And not like in the heydays and when it was easier to raise. And um, what kind of level of proof that it's working are you looking for these days?
So I think it's one of the hardest questions to answer because it's very dependent on the company and what you're trying to achieve at a company. So it's different for a SaaS company than it is for a consumer company, and it's actually different even within different types of SaaS companies, right? And so it is extremely difficult to answer the question straight on. But I think the right way to think about it is to look at it from an entrepreneur standpoint. You say, um, what type of validation would make you confident this is working, right? Like, let's have a really good, completely personalized to you, to your business situation, conversation about what would tell you this is working. And I will throw out there that capital muddies the waters. Now, most companies to succeed need some capital. So the analogy I use for this is in order to live, we need to eat. And so if there's a buffet in front of you, there is some amount of food you need in order to be healthy and thrive.
Right.
But there's better uses of those calories and there's worse uses of the calories. And then there's just overabundance of those calories in ways that we know are bad for us, right? So if we eat, 2,000 calories at the buffet, like that is really bad for us, right? And so uh, capital abundance sounds good for a lot of reasons. And you always think as the entrepreneur, well, I'm in control. It's okay because I can burn it at the speed that makes sense for my business. But in truth, that's not really what happens. And probably most of us in front of the buffet have the same problem. Like having the right amount of calories when it all looks delicious and it's right there in front of you is probably hard to do for almost all of us as well. But the challenge starts to become that if you start throwing capital at metrics inauthentically, right? You start a chain of vanity creation in your startup that will ultimately have potentially irreparable harm because you start playing this game and you need to keep playing it. And then when you keep playing it, you constantly seeing a diminishing return in performance for a whole bunch of reasons. I've blogged a lot about this, but it's one of the biggest things that's misunderstood at startups. It's like, well, if I'm able to put $1,000 into whatever Google AdWords and get, $2,000 back. I should be able to put $10,000 and get 20,000 back. And I should be able to put $1 million and get $2 million back. But anyone who's done this knows there's a diminishing return.
Right.
There's always a diminishing return. But as you're trying to scale, you cross over the diminishing return to a negative system, a negative return. But you have so much pressure to scale and you have the capital to do it that you can easily muddy the waters and start getting inauthentic results. I call that vanity results. But then you start selling those vanity results to investors and they get excited because they don't understand that it's vanity results. And so then you have people at the table who just want to see you keep doing that. And so you just keep doing that to a worse and worse and worse return until one day you're running out of money and you need somebody to put more in. And everyone looks at it and they're like, I don't know, this doesn't look like that good a business. Right. And that's really destroyed more companies than anything else I've seen outside of truly not finding any form of product market fit. And there's this funny notion in our industry that product market fit is like a static thing or binary thing, so that if you find it, you can just scale infinitely from there. And I don't think it's true at all, right? You can find it and then hit the diminishing return curve in performance against it, and then just destroy your company because you're overcapitalized and you use capital to try to overcome the fact that you're not getting the results you want. And I gave a marketing example, but it can be a sales example. It can be an engineering development example, right? It's like, well, we're just a few features away from huge acceleration in the product, or churn is going to drop by 50% when we launch these 27 features. But it turns out, usually every additional feature is less impactful than the features before. Yeah, there's some noise to that, and some features really are impactful. But usually, each incremental feature creates a bigger code base that needs more support and is incrementally less impactful than the one before. And so you hit these diminishing returns everywhere, and it drives more and more vanity thinking. And so getting back to simplifying this, you're looking to create systems in your startup that work and show positive return. And then you're looking to invest in two things, those systems, and scale those, but not beyond a point of negative value where the diminishing return takes you negative. And at the same time, finding new S curves to invest in. So new experiments to create new S curves that you can accelerate against and scale those. And I would just summarize by saying that our biggest problem is people don't like the idea of experimentation when they have capital. They like to skip that phase and think everything will, of course, just work if you apply enough money against it. And that's pushing a rope, right? And it doesn't actually work.
Yeah. I think that's the best advice for anyone at sort of or especially the earlier stages, even though experimentation certainly continues. But I I think especially first time entrepreneurs feel so much pressure to scale, right? And in a lot of that is actually artificial. I think a lot of things that founders put on themselves above and beyond what investors might expect, again, because they're overachievers and they want to do what they think is the right thing, but it comes back and bites them in a massive way.
This is I think a view that's opposed to most of our industry, but I would say raise money because of what you've proven, not just to prove things. So you might raise a little money to experiment, but primarily the reason you want capital is because you've proven things that work. The second you're raising lots of money for things you haven't proven yet, constantly to prove things, the pressure really amps up because you really should be doubling your valuation every 24 ish months, right? In terms of meeting the expectations of the capital, right? And that's a lot of pressure, especially if you're maximizing the amount you raise at every turn and the valuation at every turn, right? So it's like, how do you constantly live up to that pressure? Well, for a lot of people, they just burn faster and they create more and more vanity until somebody calls them out on it. And I think for those who don't know our industry or someone really early stage, I just want to make sure people understand this is the overwhelming story of venture capital, right? Like I couldn't give you an exact number, but I would say 90%, 95% of companies that have raised over $5 million, this is what happens to damage their businesses, right? Very few actually succeed because of the sort of very unhealthy approach the venture capital industry has. The grotesque example I give for this, I give the food analogy. The other one I give is, the industry's viewpoint is we're going to inject steroids in babies and find out who will become an Olympian. And for everyone else, yeah, we might have ruined their life and their health, but it's not our problem. Right. And I would say be really careful not to become the non-Olympian baby whose life was damaged because reckless people just didn't care. It's still your business. There's still tons of upside, even if you're not a multi-billion-dollar business. And so you want to raise that venture capital. I don't mean the first dollars in per se, but the continuous capital, not because of vanity metrics, not because you're trying to figure things out and need a lot of money to do it. You want to raise it because you're proving things that mean you're not compromising your potential. And when people say silly things like go big or go home, I always joke it's like go big or ruin your whole life. It's like that's not like it's not, first of all, a real thing for a bunch of reasons. We could talk about that. You need to have some level of ambition, but people get carried away about what that needs to be. And you can't become a $1 billion business without becoming a $10 million business. Right. So there's stuff that has to happen on the ground that VCs like to pretend doesn't happen, but it has to happen. And so this idea that it's like this binary, like if you don't burn the bridges behind you, you can't succeed. I don't really think that's true at all. And it hasn't been consistent with the best successes I've been a part of. But our industry begs to differ because, as Sam Lessin said, like there's an industrial venture machine that is trying to run a very specific program that really is about getting higher and higher valuations for their companies so that they can raise more and more money. And right. Entrepreneurs get caught in the VC set of incentives: deploy as fast as you can, get markups, raise bigger funds. And in a way it sounds good because you're like, well, that's access to capital, but that's because people think capital has insights and that capital is the game changer. And again, yes, you need sufficient capital. So I don't want to diminish that. But when you start getting beyond that sort of first experimental capital, it comes with all of these trade-offs and downsides that you have to be very diligent about. And if you raise $50 million at a really high price because you have a great business, by all means, that's awesome, right? If you have a machine you can invest in and you're getting unbelievable returns, that's what Uber looked like. People don't totally understand that because they get very caught in a profitability mindset. Profitability is kind of complicated here. Anytime you can get great return by investing, you wouldn't want to be profitable. Right. So people hear what I'm saying and they think I'm talking about profitability. I'm not per se talking about profitability. I'm talking about unit economics and showing systems that scale and have real high intrinsic value creation. And that's the point. Like, I was very lucky to be in this company, The Trade Desk. It's now a $50 billion company. We burned $7 million before going public, right? And Jeff Green did a brilliant job building that company. But again, he was always focused on building intrinsic value. His competitors raised hundreds of millions of dollars, but they got very caught up in the vanity game, right? So it's intimidating. You're looking at your competitors and they've got hundreds of millions of dollars and you've burnt less than $10 million in the lifetime of your company. But it ruined those companies. VC ruined, and there were many of them, dozens of companies that raised a lot of money, and VC ruined those companies, whereas Jeff just kept focusing on intrinsic value. And he was the better entrepreneur. He built the best business. And he owned a tremendous amount of the business at the end because he didn't keep diluting it. It seems very non-dilutive when you raise $100 million at a high price. It is so much more dilutive than people think because all the dilution's in the burn rate. It's not in the deal you cut in the moment. We could talk about what that looks like too. But when you raise $100 million, your burn rate's going to be high.
Right. And then most likely you'll need to raise again at some point given you.
And if you're creating enormous true intrinsic value, it's no problem. If the scale of the intrinsic value is way out ahead of the capital you're raising, it works great. But that is so rare. So that's like what Facebook looked like, what Uber looked like. But that is so rare, right? And so that's why most venture-backed companies don't work, is because the capital itself destroys the companies.
Yeah. And Eric, you actually got ahead of the question with your example, the question I wanted to ask, which is, especially like in education, for example, there are a lot of folks that are raising tons of money early on, blasting with the free offer to teachers, right? Getting a lot of the metrics around usage, but then where's the real business, who really pays for it, right? And I think that's something that, certainly I kept looking at at an early stage of classic, but I see that's happening now again with a lot of AI boom happening in education. So your view is you play your own game, you focus on your intrinsic value that sort of you're creating and actually monetizing the business as opposed to just blasting.
Well,
Is that?
so let me try to address that because every
Yeah.
company is unique. I could get behind a company that had a free offering that scaled up the free offering and didn't monetize for a very long time. But what would the circumstances be that would make me excited about that? A lot of companies that look like that actually hide the fact that they have terrible engagement. So showing a lot of free users, but with lousy engagement, that doesn't sound exciting to me. But if you show me a lot of free users with extraordinary engagement, I would say, boy, you might be building intrinsic value here, even if you're not monetizing. Intrinsic value is not always economic, but I
Mhm.
think you've got to demonstrate that there's something quite powerful happening with those users. And then what I would ask is not, hey, you need to go monetize these right now, but I would say, how do we think about what the value of a user is? Because if we know, let's say you're spending $10 to acquire a user and you're not monetizing that user right now, how do we get confident that the value of that user is much more than $10?
Right.
Because if we don't get confident about that, we probably shouldn't be spending $10 per user infinitely, making it look like we have lots and lots of users, but we're never going to get a return on those users. So it's harder when you don't have economic levers of return right away.
Mhm.
But that doesn't mean that never makes sense. Facebook obviously is a great example where it
Right.
made sense. But I think you've really got to get into an interesting discussion about how do we think about the value that we're really going to get from these users, and maybe even run some experiments that maybe you don't turn on monetization, but you experiment, let's say, with premium features, and you're like, geez, this is really interesting. When we offer the premium features to 5,000 of our 5 million users, we're able to average monetize at $30 a user, right? So we're not ready to roll that out to everyone because we don't want to create friction around virality or whatever yet. But boy, there really seems to be a great return on these users, right? But I think you have to be very thoughtful about what you're trying to achieve because there have been so many companies that have scaled enormously around the size of their database or the number of their users without really any sense, and they've invested in that scale, right? I think there's this dream that everything's just viral, but they've
Right.
invested financially, meaningfully in that scale without a real sense of what the value was of that scale, only to find when the time came, and we've had companies like this, that the value was very low, right? Partially because usually in many of these cases, the engagement is actually very low,
Right.
right? But I don't think like Dropbox's premium freemium offering in the early days was a bad idea. I think it was a great idea, right? But I also think they had a pretty interesting notion of what the return on that would be. What percent of people over time would grow their Dropbox big enough that they need the premium version of it and spend money, what the economic return was on that. And so you can start to model that and invest in that, right? It's
Mhm.
hard to really aggressively invest in something without any notion or robust expectation of what the return is, right? And I think a lot of people fool themselves there. But just like I'd say, this isn't all about profitability, nothing
Right.
wrong with profitability, but this isn't all a statement about profitability. It's also not all a statement about immediate monetization, right? I think there are trade offs there. And I think if you want to attract a lot of capital against a model that doesn't have easy monetization, yes, you can use vanity metrics and tell BS stories. The best way to do it is to actually show, a robust model of what you really think is going to happen and be able to stand behind it. I think that's a lot of capital that gets excited about that.
Awesome.
It doesn't
That
mean you
that
can't BS people and hand wave and find other
yeah.
ways to do it, but then you're back on that vanity train. And
Right.
I think that puts you in a very bad place because if all of a sudden you become convinced you're never going to see the return and you want to slow down investment, you have a whole board of investors who are sitting there going, wait a second, you claimed you were going to go from 1 million users to 20 million users in the next
Right.
2 years. Why do you want to hit the brakes now? Are you crazy? Why we shouldn't have given you money, right? And so you don't do that. Instead, you just
Right.
keep accelerating even at worse and worse return.
When the economics that yeah, exactly. Understood. And I know we are about to wrap up, Eric, but one area I wanted to talk about is around hype, right? Things that are now hype, like on the one hand, on the business model side, right? A lot of the most valuable companies are B2B SaaS. AI obviously is everywhere. Every startup is putting AI on on their deck these days. What's your view on that, and sort of how to be non-consensus and right, and as founders even think about their ideas? Should they pursue B2B SaaS AI to solve something, or look on the contrary in a non-consensus space?
Yeah, I, I would say to founders, first of all, we've done a 20-year study of what was the hottest theme in every single year and what was the company born that year that was the most valuable company going forward. And it's never been the case that the most valuable company in a year born was in the theme that was the hot theme of that year. And you see it always trails by like 5 to 7 years. So if you
Mm,
look at when OpenAI was founded, which is the company that has inspired this latest hot trend, it's
right,
like 2016 or 17 or something like that, right?
right,
So that's been a consistent thing through the last 20 years of venture. People get very excited about themes because just like entrepreneurs, or just like VCs tend to, in a world of great volatility, look for signal, capital flowing into something, lots of entrepreneurs talking about something. Those are signals that help entrepreneurs be confident enough to take leaps. I would say focus on real problems, like not tech areas, not enablement, but real problems, and figure out how you want to solve someone's, there's a big enough problem that you want to go solve that you think you have a unique view of, and fall in love with the problem, not with the tools, because I see AI as a set of tools. With the
right.
tools, AI will be relevant to almost every single company. But I think saying, oh, I've got to go found an AI company is not really making a statement about a problem you want to solve. So I would say let's focus on the problems you want to solve. Hopefully, there aren't lots of people doing an incredible job already solving those problems. You have a unique view on how you want to solve those problems. You get really close to your customer to understand how you do a better job than anyone else solving the problem. And then, yeah, then you can focus on what technologies are available to you to help solve that problem. And inevitably, AI will be one of those technologies because it's the next generation of computing and software. And just like, nobody today has a software stack that has no open source in it. Nobody is going to have a software stack that has no AI in it. But I think there are going to be a limited number of like pure AI companies that the problem they're solving is just AI, right? And there are going to be many, many companies that are solving problems for customers using all the tools at their disposal, including AI. And I would tell entrepreneurs focus on problems, not themes.
Beautiful. Thank you, Eric. I think that's a perfect way to wrap up today's show, focusing on the problems and making using all the tools available to you to solve really important problems and unmet needs in the marketplace. Any other parting thoughts, or Eric, the best way for folks to follow you and keep in touch?
I'm ePaley on Twitter, and relatively active there. A few times a year, I'll put out a pretty lengthy either essay on Twitter or Medium, and you can find that. I'm at Founder Collective if anyone's interested, and appreciate everyone hearing my view of the world or my compass on things after 15 years in venture capital and about 25 in the startup ecosystem. But I also just want to say, Vlada, we got to work together for a number of years, and I feel very lucky and have learned from you and have grown from that experience. And so thank you for that as well.
Thank you so much, Eric, and thank you, guys. And if you have questions, comments, please leave them on the stream, and I'll go back and try to relate as much as possible from it. But we are all lucky to learn from Eric today, and thank you very much.
Thank you.